So look, I think it's crystal clear that this economy is decelerating at a pretty fast rate, and the consumer is blowing through their cash. So any cash reserves they had coming into this year because of inflation, and just look at fuel costs. You were just talking about that. I mean, at some point in time, the consumer goes through that excess cash. They stop spending discretionary income because they don't have anything. And then that goes into the economy slowing down. So I think you're going to see revisions on second quarter earnings continue to accelerate. The data that we're going to get in July and August, which will reflect this second quarter, I think is going to show how tough it really is out there. And then lastly, you have a Fed that is going to aggressively tighten into this environment. And I happen to believe that they're not going to be able to navigate a soft landing. So if you think there's not going to be a soft landing, then in my opinion, you're going to have to see the VIX in the 40s. You're going to have to see the S&P 500 down at least 30+% before you can comfortably say that we're near a bottom, or at least enticing for us to start buying risk assets for our clients. So we're staying on the sidelines here for a big chunk of client assets, being very defensive, just waiting to see when we feel comfortable adding, because again, I think this is one of the worst setups we've seen in recent history.
So we are nowhere near a bottom?
In my opinion, we are not anywhere near a bottom. I mean, the Fed has just started QT. They haven't even raised rates on, 50 basis points, or they're going to raise another 50 next week, possibly another 50 in July. So this is just starting. Because the other thing that's going to happen, too, is as these companies start to revise earnings going down, they're going to start cutting jobs. And that's usually very, very late cycle in the economy. We haven't really seen that yet. We're seeing some hiring freezes. We're seeing some company do some slight layoffs. But we haven't really seen a big spike in that. And that ultimately is what's going to happen. And I believe we're heading into a recession, and that will be proven next year by the data. The market will probably bottom before we get to that point. But I think maybe fourth quarter at the earliest.
Yeah, tell me, as consumer credit is on the rise, meaning they're using their credit cards more and more, some people feel really empowered, they have a job, they have some savings. There's others who are using it to buy gas and food. Some live paycheck to paycheck. You said you're very concerned about those families.
Yeah, I mean, look, debt is not a good thing to have. And credit card debt's probably the worst when you look at the interest rate these companies charge you. And so ultimately what happens is families are going to start charging things on their credit card, which we're seeing that, and those numbers go up. And then there'll be a point where they can't afford to pay the bill, and you'll start to see delinquencies. There's already an uptick in families that are 30 days behind on their payment. Now, they're very small changes, but that's how it always starts out, because at the end of the day, if the price of gas is double, if food costs are up 30–40%, if housing is up huge, where are they going to get the money from? Their income is not increasing at the same level as the cost of living. So they're having to live on borrowed money, and at some point in time, that ultimately is what breaks the back of the consumer and ultimately the economy.
Right, and it sounded like you liked cash at this point. At what point are you going to put that cash to work and become an investor again? Where are you going to put the money to work? I mean, you're sitting there with the cash. What are you going to do?
So I think you're going to have some amazing opportunities in the NASDAQ space. Technology is going to continue to take it on the chin, in our opinion. But I think ultimately when we do hit bottom, that's going to be one of the best places to be for longer-term investors. Right now, as far as when we will put that cash to work, we've told clients late third quarter or sometime fourth quarter is our best educated guess right now. But there's still a lot of things that are going to unfold here in the next few months that's going to really kind of dictate how fast we get to that bottom. I think this summer is going to be extremely turbulent, with most of that turbulence to the downside.
So you think at this point, when people say, I usually am fully invested, what percentage of a portfolio, you said it's okay to not be fully invested. In fact, what percentage of a portfolio should be invested versus that might be in cash or something extremely liquid?
Look, that obviously depends on everyone's individual situation and what their goals are. But I can tell you, we have a very nice cash position for clients. We have another big position in longer-term treasuries, because we think that the 10-year bond is actually going to go down, because the Fed is going to aggressively raise rates on the short end. That's going to cause the economy to slow down so much, in our opinion, that rates will drop on the long end. and that will cause bond prices to go up. On the equity style, the only equities that we have even bought here in recent weeks are utilities. And that's how conservative we're being right now, or defensive, I should say, with the overall portfolio. So we're as defensive as I've ever been in my 24-year career.
That's amazing. That says it all right there. Eddie Ghabour, nice to see you, managing partner.